I knew this was coming. There were warnings.
Greek members of parliament voted early last Friday morning to approve a new multi-billion euro bailout deal aimed at keeping the nation afloat, and 75% of the nation's parliament voted yes. The deal's already been approved by Greece's euro partners and will require not only substantial tax hikes, but more tough spending cuts as well. Of course, all in return for 85 billion euros in funding. This is Greece's third bailout program in 5 years, and luckily gave them enough funds for their 3.2 billion euro payment to the ECB, Thursday, August 20th. Shockingly enough to startle even Captain Renault from the film Casablanca, on the very same day, Greek Prime Minister and head of the Soros front group known as the Syriza Party, Alexis Tsipras, followed fellow cartel henchman Varoufakis' career path, exiting stage left, post-haste, with a crocodile tear-strewn face. Tsipras attempted to salvage his credibility by citing a moral duty for early polls now that we're in the bailout number 3 phase, setting the stage for a potential September 20th snap election. Turning to U.S. markets on Thursday, the Dow Jones crashed by 358 points, off by 2.1% for the day, closing at a new 2015 low. In fact, nearly a 10-month low, with the index breaking under the 17,000 mark to close at 16,990. The S&P 500 nearly followed suit, with a new low not seen for almost 7 months. The dollar index is also down 1% in 2 days. In stark contrast, both silver and gold shot up this week amid growing concerns that a physical silver shortage continues brewing. Looking more closely at commodities and the aforementioned silver shortage now showing signs, we see that gold rose 3% for the week, and silver rose back over $15.50 an ounce. According to silver doctors, the physical silver shortage is already here, if we look at evidence that they've compiled from wholesalers. They said the U.S. Mint decreased coins available to authorized purchasers by 29% in 1 week, and then 20% the following. And a 100-ounce bar distributor received only 30% of their scheduled bullion delivery. Also, Sunshine Mint 1-ounce rounds were on a 9-week delay. It may be just a matter of days and weeks before premiums shoot up. Viewers who are particularly interested in this subject can check out some of the thought-provoking interviews that Future Money Trends has recently published on the silver shortage with the likes of Silver Guru 22 David Morgan and Steve St. Angelo of the SRS Rocco Report. Luis Camarasano over at Small Gold has done some interesting snooping into the U.S. Mint's definition of authorized purchasers, finding that the Mint is apparently unable to actually provide any information as to who its authorized purchasers are, adding fuel to the fire of theories by Ted Butler and others that institutional players like JP Morgan may be gorging themselves on American silver eagles. Flashback to late 2008, where premiums for 100-ounce bars, usually the cheapest new retail bullion, were 25 to 50%. Today, the premiums are around a mere 7%. To put this into perspective, silver spot price was $10 in mid-October 2008, and 100-ounce bars sold for about $14.65 per ounce on eBay. That's a 47% premium. A substantial portion of silver production, as you may well know, is not derived from silver deposits, but is obtained as a byproduct of mining for other resources, particularly copper, a metal that has also seen a severe decrease. Down 29% in 1 year, in fact, Dr. Copper is currently trading at just $2.27 per pound, the lowest level since 2008. Oil fell significantly week over week for 9 weeks in a row, with analysts like Marin Katusa and Harry Dent pegging outcomes in the $40 range. Thursday, it reached near $40 for West Texas Intermediate, 6-year lows. The 2008 low was $30.28 in December. This is a repeat of the 2008 depression that wasn't fixed, but was just delayed until a lucky 7 years later. The Federal Reserve's lending rates have remained near 0 cents. Now, there's no ammunition left to stimulate, and the death of the dollar could be upon us. Unfortunately, no certainty was garnered from the latest Fed minutes release, so we'll have to wait until its next meeting on September 16th, when the high priests of Keynesianism will once again regale us with their infinite wisdom. In digital currencies, the Bitcoin price is still trying to recover the almost $30 it is short from a flash crash that happened late Tuesday. It was supposedly spurred from margin calls on Bitfinex, the largest volume online trading platform. We were surprised, yet not surprised to see an important message when logging into our local Bitcoins account regarding the locking out of New York residents. As we mentioned last week, California is trying to pass their own BitLicense regulation. California is the largest U.S. state by population. If New York and California are restricted from Bitcoin use, Texas could rapidly emerge as the new center of financial innovation in the United States. And it's the second largest state. Texas's fourth largest city, Austin, is already a huge tech capital, and the state as a whole has been receiving disgruntled Californian businesses and residents for several years now. Bitcoin development is reaching a new headway, as a split between the community is leading to a fork in the software system and perhaps the blockchain itself as well. This is a struggle that will ultimately be won by the majority power. The squabble is over what many see as a simple, needed change to increase the block size and thus increase the number of transactions the system can handle. This type of change is argued by many as being essential for network capacity, scalability, and the future of Bitcoin as a world currency. However, others have argued that potential security vulnerabilities and the risk of bifurcation possibly leading to lost money from double spends that may occur in the confusion simply aren't worth the Bitcoin network being able to handle more than 7 transactions per second. The new software is supported by 2 lead developers, Gavin Andresen and Mike Hearn. It's called Bitcoin XT, and if it succeeds in getting 75% of the miners using it, after 2 weeks' notice, it will begin generating blocks bigger than 1 megabyte. Under this scenario, there should be little disruption. At most, users running the old software would simply need to upgrade their software in what's called a hard fork, something which already happened before, back in May 2013 after the huge rise in Bitcoin price. At the current rate of Bitcoin adoption, without this key change, the system would reach maximum saturation of transactions by as early as next year. On Tuesday, the first block was mined on a machine running the Bitcoin XT version of the software. In many ways, Bitcoin XT development has been accelerated by proponents in the Reddit community, and now a new Reddit page, called Bitcoin XT, has been created as of June 2nd in order to discuss the new software update. This new Reddit page is a clear response by Bitcoin XT advocates to the banning of discussion about Bitcoin XT, or contentious hard forks of Bitcoin Core, by community bigwig Michael Marquardt, who exerts significant control over the Bitcoin Talk and Bitcoin subreddits. The new Bitcoin XT page already has over 7,000 subscribers and is the 62nd fastest growing subreddit in the last week. The Bitcoin Core versus Bitcoin XT camps could be warring until January next year, when the Bitcoin XT software allows larger than 1 megabyte blocks. From now until months after that, we can expect increased volatility in Bitcoin price. This should make some great trading opportunities. The most popular wallet service, blockchain.info, now has over 4 million users. Get our free Bitcoin report at crushthestreet.com/Bitcoin.